So liquid loans is a decentralized, no admin key, no counterparty, stable coin, and lending protocol. And basically the way it works is you just bring in some of your native coin of the chain, your Pulse coin, and you can put them into a contract as collateral, and then mint yourself some stable coins off of the value that you've brought in. There's a minimum collateral levels that have to be maintained, of course, because you can't let the value of what you've brought in as collateral fall below the value of stable coins that you've minted. So that collateral level is pretty low. It's 110% or 90.9% loan to value ratio. So as long as your collateral remains above that, and we recommend much higher than that, 300-400%. You hear a lot of people talking about 1,000% just to withstand some market volatility. But anyway, then you just make yourself some stable coins, and you can go spend those or swap those or do whatever you want. Essentially tax free, because you never sold your asset to begin with, your Pulse coin. It's a loan. It works similar to it's a fork of the Liquidity protocol over on ETH chain. And this is exactly how a lot, some other protocols work too, such as the Maker protocol. It's similar. You put in ETH or some other collateral, and you can mint yourself some DAI. There's other aspects to this protocol. So there's a stability pool that you can deposit USDL into, and there's rewards that get paid out to you while you're in the stability pool. The purpose of the stability pool is to absorb any of the liquidations that might occur. So you have USDL in the stability pool. Essentially, if there was a liquidation of one of those vaults that somebody had created, then you would absorb that as a community of stability depositors. So some of your USDL in that pool would burn, and then you would be accumulating the Pulse from that liquidation. And then there's a staking pool where you can put in. So this project does have a native token to it. It's called the loan token. You can stake the loan token for the fees in the protocol. There's no interest. So there's no ongoing requirement to pay or anything. Once you take a loan, there's just a one-time borrowing fee that comes out of the minted USDL that you bring into existence. And that fee goes straight to the stakers of this thing called the loan token. There's a redemption mechanism, so every USDL that's ever minted is directly redeemable inside of the protocol for $1 worth of Pulse. You will find USDL on some automated market makers, so people are welcome to go swap and trade and do the things they do, but you can also directly redeem directly inside the protocol for $1 worth of Pulse. And if somebody does that, there's a fee that comes from that as well. That fee is paid in Pulse, and that also goes to the stakers of the loan token. So that's pretty much the whole protocol in a nutshell. There's a lot of game theory. There's a lot of different strategies people have come up with to accumulate more coins, to add to their Pulse bags, to never have to sell. And the numbers get pretty insane, actually, when you compare somebody who does the traditional method that you're always, you've heard your whole adult life in investments. Hey, you need to take profits, or you need to get your initial out. The numbers are like astronomically different between somebody who sells and people who just don't sell. And one method of not selling is just to collateralize your appreciating asset. So just some real quick math on that. If you had 20 grand and you wanted to sell and always take profits every time you had more than 20 grand, or every time the price doubled or something. Let's say the price doubled 10 times, starting with your 20 grand. Every time it doubled, you took out half your bag. Well, at the end, you would have $220,000 worth of crypto to show for 10 doublings. But your coin count would have been divided, in 10 times as well. So it just gets harder and harder to earn over time when you're just withering your coin count away. Well, then just compare that to somebody who never sells their crypto, who got in early, who also started with 20 grand. And all they did was hold through those same doublings. The person who held and never sold would have $20,480,000. So that's an astronomical difference between hodlers and sellers. And liquid loans allows you to capitalize on that by keeping those coins as they're appreciating, and just minting a loan off of that value.
Sorry, that's great. That was a great introduction, Jesse. So if anybody does have questions while we're up here, feel free to raise your hands and I'll try to bring up everyone who I can. So Jesse, I know a lot of people see you and associate you with with PulseChain, or sorry, not with PulseChain, with liquid loans. Jexxa, could you briefly introduce yourself for those who don't know you?
Yeah, thanks, NrdGrl. Yeah, so I tend to sit more in the background of the liquid loans team. I'm working on some of the more technical aspects and doing a bit of data modeling, things like that, helping the team bring this to market. So coordinating various other third-party legal representatives, other tech guys as well. Occasionally I get out in front of the camera. I've got my own channel, Jexxa, on YouTube, where I do some short, snappy videos, just educating people on the liquid loans protocol and getting them to understand how it functions. So really my role is more in help coordinating, bringing it together, but also a bit of community education. Hence why I'm in here today, hoping to answer people's questions.
Awesome. Okay, great. Well, so you guys, Jesse, you asked me to do this spaces, so I know that there must be something, big coming up or about to go on. So what is it that you want people to know about right now? Because there's been kind of off and on a lot of attention on liquid loans, especially, of course, within the Hex Pulse community.
Yeah, so first and foremost, we like to educate the community, right? So we've had this narrative of never selling. I just talked about that a few minutes ago. The more people that learn that there are other ways to extract value, the more and more people in the community are going to benefit from that, right? The wealthiest people in the world don't sell their assets; they collateralize against them. And being early on in PulseChain, the earlier people realize that, the better it's going to be for themselves, right? So first and foremost, education. But secondly, there's an opportunity to get in early into this protocol as well. There is a sacrifice phase. We're right around the corner from that. Could be just a few days, could be a week or two. We're not announcing the official start date on that yet, but we are getting very, very close for people to be able to get into this opportunity.
Awesome. Actually, let me ask you a question about that because it's somewhat controversial, and you know how I love controversy. So, I know a lot of people were people were really enthusiastic. Well, depending on whether you were a Richard Hart supporter or find him dislike him, your position may have changed, but there was a lot of support for the idea that Pulse was launching with a sacrifice phase, and then even that PulseX was doing a sacrifice phase. But I know that there was a lot more questions about other products that don't have Richard or a figure that has as much trust as Richard doing sacrifice phase. So could you tell me a little bit about the decision to use that fundraising method?
Well, you can't call it a fundraising method because it's not. It's literally a sacrifice. But
Okay.
he came up with a good model for people to be able to, stand up for what they believe and show their support of their beliefs, right? So, if somebody comes up with a good thing and somebody else says, "Hey, that's a good idea. We like that good thing. We like that good model. We're going to do it too." That's really not a bad thing, right? It's like copying is a form of flattery. Some people say that. We've taken the model of the sacrifice. We've actually added some features to it where, you can specify how you want your sacrifice to feel for you, and then be shown points and stuff accordingly. So, with the PulseChain sacrifice, you've got the bigger, better. You've got the volume. With the liquid loan sacrifice, it's all very similar, but you also have a longer, better, which we think is going to, have people demonstrating their political belief for a longer period of time.
Okay, got it. So here's a question for you. Have you stated, and maybe I'm just a little bit out of the loop here. Have you stated what people are sacrificing for when they sacrifice for liquid loans?
Yeah, so they're sacrificing in basically showing their opposition of centrally backed stablecoin systems that are fraught with counterparty risk. It really is a broken system, and I'm not saying that any of these other stable coins such as USDC or USDT are ever going to fail and collapse, but it just goes against everything that crypto stands for when you have centralized parties that are running the show and taking advantage of everybody in the process. So crypto was invented to eliminate counterparties, to form trustless ways to conduct trade. And what you have now is, giant institutions that are running the show, and fractionalizing, reserving, coins and such, and just introducing a lot of risk and abilities for even coins to be shut down and turned off or taken back and stuff. That's not what crypto is supposed to be about. So you can stand up in opposition to that, knowing or hoping that a better system evolves under the PulseChain that's community driven, where us as a community benefit. All the fees go back to the community. As the price of Pulse goes up, more USDL ends up getting minted, and it's all completely community driven. Nobody can turn it off. And that's what you're standing up for, the belief that there's a better way, and that this community driven stablecoin system is that better way.
And not to get too political, but if you've probably been watching what's going on in Canada now with the
Sure.
trucking convoy, and we literally just witnessed GoFundMe get mandated sorry, excuse the pun, but get mandated to shut off the funds that have been raised for those protesters. So then everyone switched to, I think it was Give, Go, Send or something like that, an alternative platform, thinking they would be able to be in a better position, raised another $5 million. That has now just been blocked as well. So, and that seems like a negative, but I think that is a positive that is going to come out of that, because another one, that was a crypto-based one, the name escapes me at the moment, but that's emerged now as another one of these funding platforms that can't be shut down, can't have the funds taken away from the person you're trying to donate to. Now, if you don't think that is coming to stable coins as they exist now, you're delusional. USDC, Tether, those guys recently have just been pulled apart by the SEC, and they're getting so many more rules and regulations stuffed down their throat, to the point where pretty much every movement you do on those chains is going to be required to be tracked and traced. And at the point when, let's just say someone, for whatever reason, decides that the path that token you hold has, I don't know, gone through a mixer, has gone to a political belief that you believe in, but they don't. For any reason these guys arbitrarily choose, they can lock down that account or that wallet, that token. To me, that's not what I got into crypto for. And if we've got a way to bring something to market that works around that and starts to build our own parallel system next to this legacy finance system in a way that suits the normal person, average person, and gives them their freedom back, that's what I want to be a part of. So we're here to talk about a little bit of hypocrisy and things like that as well. So let's get it juicy. When I came out in support of liquid loans, I ruffled a few feathers in the HEX community. I've been in the HEX community since day one. I've been a supporter, always on stream, promoting everything, and because I really believe in it. I like what it stands for. I like the way the code was built. And when I looked across at the liquid loans code, and same as what I did when I got into HEX, I read all the code. I read the layman's guide. With liquid loans, I read the audits. I went through everything, the white paper in a fine-tooth comb, and for me, everything just stacks up. This is a protocol that our community needs. Whether they realise it or not now, it's going to be very important.
Yeah, I agree. I mean, I think lending is very important. It's definitely a very important part of crypto. That is something that I wanted to talk to you guys about, though. I mean, you're building a protocol or working on a protocol that is being built on, on a network that the primary target audience for has been very, very maximalist for the last 2 years, or has become very, very maximalist, whether that's how it was when it started or not, over the last couple of years. So I was hoping you guys could share a little bit of your experience, like what kind of challenges you've faced there.
Yeah, look, I think straight out of the gate, we were probably one of the first projects that put our hand up and mentioned we were building this. We were always going to take the brunt of the community because, like you say, everyone's become fiercely protective of the HEX community, and rightfully so. I was there at the start when things were pretty damn awful. It was pretty rough. I know a lot of the guys that came out publicly initially, they had some pretty awful things happen to them. So I understand totally the psyche of the HEX community. I get that. So for us to come out and say we're building this and be the first, we've taken a lot of blows. That's fine. We're happy to take that on the chin because we believe in what we're doing. We know where we're going. We know what we want to do. We know what we want to bring to PulseChain. So we're happy to take those knocks.
Yeah, sure. That makes sense. You guys were anticipating that you were going to experience this kind of backlash from the community because you were a part of it. So you knew what to expect. So what I'm really interested in right now is how, other protocols, stuff that right now exists on Ethereum or, other, in other places, like how will, Pulse attract those protocols to launch on PulseChain when the community is so negative about really anything. Oh, we don't need anything except for X, or oh yeah, fine, they can launch here, but we're all going to just call it garbage. And why would anyone want to do that?
Yeah, look, I think. Do you want to take that one, Jess, or you?
Yeah. So the interesting thing about a blockchain is this will be controversial when I say this. You don't need the HEX community if you're an exterior community and you see a good blockchain with that's cheaper and faster, and you say, wow, that looks like a good chain to park our protocol on.
No, for sure. I get that, right? And one of the things initially when Pulse was first announced, people were saying stuff like, oh, we should only allow good stuff to launch on Pulse. And I was like, no, you guys don't understand what a blockchain is if that's what you think, because this is a permissionless system. You cannot allow and not allow things to build here. That's just not how this works. But so I understand what you're saying. It doesn't, products, they don't need the permission of the community to launch. But why would like it's cheaper and faster, right? But if people are anticipating that they're going to get a whole bunch of hate from the core community that makes up the, community of the protocol, like, why would people do it? It
I
just
don't
seems like
think.
an extra headache.
Yeah, I think the reason why we get pushback initially is we're starting from the inside out. So the community is really tight. Like I said, fiercely protective, and have seen all the bullshit that's gone on in the space, where all the rug pulls and things like that. So they're very wary about that, as they should be. So obviously the first projects are coming from within that community. So they are going to get that pushback, and because it's coming from the internal side. But if projects choose to launch on PulseChain and they're not part of that core community, so they just, like Jesse said, they just see a great blockchain that's got a lot of users on there, it's fast, it does everything Ethereum does, it's all compatible. They're less concerned about the core inner community. They're concerned about, okay, we're going to build this and we'll bring people with us potentially, or yeah, we'll build it and we'll hope that the community uses it. Now, I think from you talk about a hate perspective, and it's a pretty strong word, so I don't know that I think it's more concern than hate. As we see outside projects, if you see an existing major protocol or project move across on the PulseChain, I think people will embrace it. I really do. I think we're just at the embryonic stage where we're going to have a few growing pains, and mark my words, you're going to see a lot of projects come from within the inner core of our community, because the thing that attracted a lot of people to Hex, where they believe in just rolling up their sleeves and getting in and doing things and making things happen. So they're a bunch of builders, they're entrepreneurial, they're go-getters. We've seen this, by the way, the community's just evolved. To think that they're going to stand back and not want to build on a chain that's just been launched for them is insane. Everyone's going to step up and come up with a project or a service or a tool. We're seeing it already, and it's only going to get bigger and better.
So you think that over time that like massive protectiveness will die down as people drop their guard a little bit and realize that Pulse actually needs for other things to be built on it to survive?
I think the guys that have been in Hex since day one, and the guys that have coalesced around that later, will still have a very keen eye for what comes across, and will be still looking to protect the community as much as they can, even though it's going to get bigger and there's going to be different facets from different areas. But I think there will still be that protective mentality. And if something looks like an obvious scam, then obviously people will call it out, which they do anyway now on all other chains. But that's not going to stop people getting involved in these things. People just love to chuck their money into crazy things sometimes. That's crypto.
Gotcha. Okay. Sure. Jesse, do you have anything to add there?
Yeah, so you are seeing community members, just like Jexxa said, that are stepping up to the plate and saying, in the absence of major protocols announcing that they're coming to the PulseChain, we're going to do it ourselves. Richard's brought us to this stage, right, where now we have a blockchain that's available to us, and it is not, contrary to some people's belief, it is not just for Hex. It is not just so we can take or sell Hex from me to you, and then the next time I want to buy Hex, I'm buying your Hex back from you, and we can just pass money back and forth from each other. It's so that we can grow as a community and bring other entire other communities into the PulseChain. That's why it exists, and you're seeing Hexicans step up to the plate and realize that. And they are building bridges. They're building swapping platforms, and they're building gaming, gaming and NFTs and lending and all these different things that are necessary for a blockchain to exist. And a lot of these things, almost nearly all of them, are coming from inside our own community.
Mm-hmm. Okay, so the tide is turning. So here's the thing. So, the big Bitcoin maximalists who, regardless of how well Hex has performed and how long it's been around, are still adamantly, if it's not Bitcoin, it's a shitcoin, right? Like, what percentage of that do you think that we'll continue to see within the within PulseChain?
Let me talk about a black swan event, right?
Mm-hmm.
What happens when Richard decides he's built something, he's done, he's retiring, or he passes, or something like that, right? What happens to those people who have said their their whole investment life since they got into Hex, the only thing that they'll ever do is get into a project that he's built? And what happens when he doesn't build anything anymore? Does that mean the chain dies? It goes away? It's a complete failure because there's nothing left? No, that's absurd, right? So it's just an interesting narrative to hear that, right? So ETH exists. I have never in my life seen a project. I watch a lot of different projects and I see how they evolve, whether I invest in them or not, or get in or not. I do like to see what's going on out there in the space. And I've never heard or seen tweets or anything where people are saying, did Vitalik build this? If he didn't build it, I'm not getting in.
No, but there certainly are people who won't, and who, at least not until very recently, and even still people who will say, like, well, if Vitalik doesn't support it, I'm not getting in. And realistically, like, you have to think about what that must mean in terms of, like, the kind of responsibility that he probably feels, right? Like, I can't support anything because if I do, people will buy it, and and then what if it fails? Like, I feel like Richard is going to be the same way, and already is, in fact.
So he should be. I think he's forging the right path. He should not be coming out and supporting anything that hasn't proven itself. I totally agree with that. We don't expect any endorsement from anyone until we've proven ourselves. So we're not naive on that fact. And I don't think anyone else that launches anything. So there's probably half a dozen other projects I know of getting launched as well that haven't been endorsed openly by Richard either. And that's cool. That's the position he should take.
Yeah, I agree. I agree with that completely. What I'm saying is there are people who say, like, I won't buy anything unless Richard endorses it or unless Richard has built it. And I mean, I think presumably by the time people who feel that way, like, I guess presumably will have possibly make enough money while he's still creating products, so they won't have to.
Yeah, that's fine. And that's totally fine. So I think the biggest endorsement would be, what if someone brought a protocol to the network, was never endorsed, just went and done its thing, and then all of a sudden it starts getting used, and Richard finds, oh, okay, this thing actually got a real important use case on the network. And he may never come out and endorse it, but what if it's beneficial to his network and to his product to start using that protocol? There's a real reality that happens.
Yeah, of course. There are different kinds of endorsements and they don't all have to be explicit and verbal. So I guess what you're saying is you think that over time do you think, this is a question, do you think that over time that narrative of it has to be endorsed or created by Richard is going to die off? Do you see it dying off already?
I said diluting already. Now, there's always going to be the core group that are true to the cause, and I totally appreciate that. They don't want to see anyone get harmed. They trust what Richard's doing. He's got the runs on the board, let's face it. That's totally fine. But I mark my words, and I'm seeing it happening now. Your favorite YouTubers that you're watching that are part of the Hex community, that have done good things in the Hex community, starting to bring their own projects to life. So what happens when that?
Sure. I mean, I said a long time ago that with the, with Pulse's launch, we were going to see people support other products and that some of those products would ultimately fail.
Yep.
And that's not a theory. It's the reality of how things will go, right?
Yeah, totally. Yep.
And so I guess the question is, what's going to happen to the people who supported or developed the things that failed?
Oh, look, I think everyone's allowed to pick themselves up and dust themselves off if they've tried. Like if you don't try, then the chain doesn't progress. If people don't try and build and fail, they've got to be allowed to fail as well. As long as people aren't getting financially ruined in that process.
Well, but here's the thing: when things fail, people do get financially ruined.
Yeah, in this space, unfortunately, that's true.
So it's not really like if or, it's if those two things coincide.
Okay, so if failure was brought about by I built something and look, it just didn't get adoption or whatever, that's a different kind of failure too. I built something and it got rug pulled or something along those lines. So there's different types of failures. There's a deliberate harmful acts, and then there's I built something, just didn't quite work out.
Sure, yeah, it was exploited. I didn't realize it was an accident. I'd put rug pull, exploit, all of those sorts of things in the harmful bucket, and that doing things right, all things going well, that shouldn't happen. Now, so they're sort of, some of those are known, some of those are unknowns. But if a product was built and it just didn't get adoption or something like that, that's sort of what I'm saying. There's a harmful way of things failing, and then there's just no product fit sort of fail. I understand what you're saying. Okay, hey, I invited Stakes and Apes asked to be invited as a speaker, so I brought him up. Stakes and Apes, did you have a question or something to share?
No, I just always request the mic as soon as I get into these spaces. So, but, I'll piggyback off some stuff that you guys have been saying, about people building on PulseChain and stuff like that. If nobody builds on PulseChain, how well do you think our sacrifice bag that everybody sacrifice is going to do? Because like when it comes to NFT space, 25% of the volume on Ethereum comes from OpenSea, comes from NFTs. If we don't have that 25% onto PulseChain, is PulseChain going to go up and to the right? Who knows? I think everybody needs to keep building. Richard Hart, he taught us a lot of different lessons and stuff like that. So you should be, wary enough whenever you check out a project, see if it's something you're interested in, and check it out, make sure everything's good to go before you buy in, but don't just ride off every single, thing that other people are building, because most people have the right intentions. If you go into like any of these spaces and listen to talk to all these new projects and stuff, they're literally trying to hammer out Richard Hart's stuff that he's yelled at us for the past 8 years or whatever it may be, however long he's been around. But so don't write off all these new projects. And we actually we have an entire layer 1 that we have to fill up with PulseChain. That means we need a lot of volume over there.
Yeah, I will agree with that. Hey, TCP, I've added you as a speaker as well.
Thank you so much. Appreciate it. Yeah.
Did you have a question or comment?
Yeah, I have a question. So the whole idea of liquid loans, I'm actually doing the research right now as I'm listening to this wonderful space. So I have a question here. Let's say I put $1,000 into the protocol, and I actually mint my own USDL, which is the stable coin, supposed to be pegged to the Pulse itself. And let's say at that time, that specific time, my $1,000 worth actually $1,000, and I took it, swap it with the wrapped stable coin on PulseChain, off-ramp on ETH, cash it out over there. What will happen to my position on liquid loan? Who will take that hit?
If you've done it within the right collateral level, so let me just step back a bit. Obviously, the minimum loan you can take out is $2,000. So just be clear on that. And in order to take out that $2,000 loan, you're going to need to put in 10% more pulse as a minimum. Now, that's not what we recommend, but that's what the system, as a minimum, allows. So you've essentially transferred the value of your pulse into this USDL that you've minted. So you could think of it, I thought of this analogy last night, it's almost like a bridge, the way a bridge operates. So if you put an asset into one side of the bridge, you manufacture a asset on the other side of the bridge, and the reason why that asset on the other side of the bridge has value is because you've locked up that other side of the bridge. So you've effectively transferred the value into that freshly minted token on the other side of the bridge. This is no different. You're putting your pulse into a vault, and you're transferring that pulse's value into the USDL. Now, if you go take that USDL and go spend it or do something else with it, then obviously you've put that out into the free market. It's no longer yours. So now you're in a position where you still hold the pulse in the vault, but you've got a debt position against it. Now, if you want to release your pulse, you've got to pay back the debt. It's as simple as that.
Yeah, but the question is, let's say I'm not going to pay the debt, just like,
Yep.
I'm hypothetically speaking. Who takes that hit? Is the protocol takes that hit, or is the participant takes that hit?
I'm not really understanding your position there. So
I kind of get it. So you've put in your pulse, right? Your pulse stays in that smart contract. You put in more value than what you've minted. You've got your USDL. You've extracted it back to, USDC or through a bridge back to ETH, Coinbase, wherever you wanted to take that. And your vault, where you put your pulse, sits there, and the value of that pulse either goes up or it goes down. There's no there's no hit, there's no loss or anything like that at that point in time. Now, ideally, the value just goes up, right? And you come back and you look at your vault the following day or a week later or a year later, and it's done very well for you. That amount of pulse, that value of pulse that you put in your vault could have done 100x, and you see, wow, I have all this over collateralization. You could mint additional stable coins. You can withdraw your excess collateral. You could pay back your loan if you felt the desire to do that, but if you're over collateralized, you wouldn't need to. And you can mint additional stable coins, right? So if the value goes down, however, and it gets to within 10% of what you've minted, you're going to lose those pulse coins. They're going your vault is liquidated. And here's how the next mechanism works. Here's how the hit works that you're talking about. Those pulse coin, your debt is closed. You no longer have a debt position. The pulse coins migrate over to a community of stability depositors who are standing by in a large pool of stable coins. Their stable coins will burn as if they've paid your debt, and they will collect your pulse coin.
Okay, so you have a burning mechanism for that stablecoin then?
Yes. So if you were to pay back your debt, you would have to bring USDL back, right? If you borrowed $2,000 for the USDL, minted $2,000 for the USDL, and you decided you wanted to pay that debt back, well, you'd have to bring 2,000 USDL back.
Yeah, but that USDL won't be in circulation, or will it be in circulation?
I think Jesse's dropped out. So if you choose to pay back that debt, So you've got two sides of a vault. You've got a collateral side and a debt side. So if you choose to pay back that debt, then that USDL is effectively burnt. It's destroyed, and then your pulse is released. So we can only, within the system, it will always remain solvent. It will do everything it needs to do to remain solvent. So what that means is, and this is very important, what that means is one USDL can always be redeemed for $1 worth of pulse. And that sounds like sorry.
And it's back to the pulse at all time. So if I wanna pay and unlock my vault, if I want to pay with that USDL won't be in circulation anymore. It will be burned in order to release my pulse. In the same time, if I want to take that USDL and run away with it, right? Because I extracted my pulse value, the pulse and the vault will be actually dumped in the stability pool, where other stability participants will be kind of like burn their USDL token in order to recreate that pulse, sort of speak.
So you're definitely on the right line there. So if you take your USDL and you never intend on paying it back, which is totally fine, system allows for that. But that debt at some point in time, if your collateral gets to a point where it's not worth as much as you extracted, that debt needs to be paid back. How do we do that? We take some USDL from the stability pool providers and pay out that debt position that you created. What that then does is it frees up that pulse that was sitting in that vault as the collateral, and then gives that to the people in the stability pool. So that's the reward for being a stability provider, is you deposit USDL, and over time, if and when liquidations need to happen, a portion of your USDL will be used to clear those debts. But in return, you'll get given a portion of pulse, and you should get that at about a 9.5% profit. So the pulse you get back should be worth 9.5% more than the USDL that left your wallet. That's your reward for sitting in that pool. Now there's an additional reward in that if you're sitting in that stability pool, think of it like being a liquidity provider on a deck. You get given the loan token as well as a reward. So that's how the emission works for the loan token, is it goes to those people that provide the stability. Now let's take it one step. Okay. Sorry, you go.
Yeah, absolutely. No, I was saying the money is being made on the back ends, right?
The money's been made. So the money goes back to the community.
Yeah, but it's like the actual money for the protocol to sustain itself. It's being made on the back end on whenever you are actually minting your USDL. You're gonna be having a 0.5% to 0.5 to 5%. And when you actually want to pay back, release it, you're going to be also hit with that. So it's on the back end. It's like a credit card, basically, right?
No. So what happens is when you mint, you pay that one-time fee. Okay, that one-time fee that you pay goes to the holders of the loan token. So the system is owned by the community. If you hold that loan token, you are an owner of this stablecoin factory. So you pay your 0.5%, you mint your loan, your stablecoin, you go out, you do whatever you like with it. At the point in time you choose to pay that back, and there's no time limit, there's no interest repayments, so this is a timeless loan. But let's just say you do get to the point where you go, you know what, I want to pay it back. Simple. You just send back the USDL to that vault. There's no other fees. Send it back, clear the debt, take your pulse. Simple as that.
Okay, so there's no double.
No.
Okay, so only one-time fee. It's only for minting the USDL.
While we're on this line, let's talk about something else, because this is really important and can be confusing. Okay, so we just talked about paying back a loan vault. That's totally fine. But what if you don't even have a loan, but you hold USDL? The comment we make is it's always redeemable for $1 worth of pulse. one USDL is always redeemable for $1 worth of Pulse. So let's just say someone sent you 100 USDL, and you go, you know what? I'd actually prefer this to be in Pulse. So I want to redeem it. So this is outside of the loan vaults. You can send that USDL to the system, and it will destroy that USDL and give you $100 worth of Pulse back. So it's fully redeemable. This is really important, because in the likes of something like Tether, do you think you can redeem one Tether for $1? Well, physically, they don't allow that to happen, but they're so fractionally reserved now that it's ridiculous. You could never do it. So this system stays fully solvent and is always redeemable for $1 worth of Pulse.
I like the idea. I like the protocol. I hope you guys are succeed in this project and actually putting together some question, maybe dive deep a little bit. And I hope I see you probably we do some sort of podcast on my channel or something like that, and we can talk more, explain more to the community. I wish you good luck.
Thank you. I think we're building something brilliant. I think it's just a matter of educating people what it is, and once they understand it, they'll get where we're coming from. In terms of now that we've got a lot more people in the room, if you want to understand this and you're not keen on reading white papers, if you go to my YouTube channel, Jexxa, I've got about 10 or 11 episodes that are broken down into bite-sized pieces, like 10 minutes per episode, and I basically go from the very start of liquid loans and explain it piece by piece so you can build up your knowledge and understand how it works.
So sorry I dropped out there a minute ago. That happens every now and then on my Twitter for some reason.
I think it happens to everyone's Twitter spaces. It's very common.
I want to talk a little bit about redemptions and how that's one mechanism that helps hold the peg of the USDL, right? So when things are traded in liquidity pools, it's basically ratios. You've got a token on one side, a token on the other. If somebody sells, they're depositing on one side and withdrawing from the other, and that shifts those ratios and adjusts prices.
Yep, that's the concept behind impermanent loss. It's like the understanding it is was probably the most important concept in all of DeFi.
Right. Now, what tends to happen is, and you see it with stable coins too, if Bitcoin dumps, ETH dumps, and then ETH is paired to a stable coin like USDC or something, the USDC actually gets pulled down with it. So while you may be looking, on the charts, you see, oh, USDC is trading at $1. Well, if ETH dumps fast, 20% or so, you'll also see that that USDC will wick down with it, and it'll be trading at 80 cents, or there's ARB bots that pick it up pretty fast. Stable coins are not stable except for the arbitrage that's able to happen, because there's typically some sort of redemption, or there's some sort of opportunity where you can buy the stable coin back up. You can buy it at a discount and then get $8 worth of something somewhere else. Now, in the case of USDC, you would hope that you see USDC trading at 92 cents. Oh, I'm going to buy some of that. I'm going to send it to Coinbase, and I'm going to sell it for fiat. I've literally noticed attempting this, that when you do that, your transaction just gets stuck on Coinbase, and they will refuse to give you $8 worth of fiat when the markets are bad, when the markets are way down. You'll see that everything's really laggy on Coinbase, and meanwhile, they're doing all the ARB opportunities. They're buying the price back up, and then they'll open it up to everybody else later. So your transaction will get stuck. It'll just be pending or whatever for a while. Now, in this system, the same thing happens, right? If Pulse dumps, USDL will dump right along with it because it's paired on the dexes to it. But that also leaves an ARB opportunity. You can purchase that, and you know that you can redeem it back into the protocol for $1 worth of pulse. Where does that come from? Well, it actually reaches into the lowest collateralized vault. The guy or gal who's sitting right there at the 110% liquidation point. And what it does is it removes pulse from that vault, and it eliminates debt from that same vault, and it raises that person's collateral level, helping the entire ecosystem of liquid loans, even in market dumps, get healthier and healthier and healthier, higher and higher collateral levels. So it's almost like if you're the lowest collateralized vault, and you're at 110, and you're like, oh man, I'm about to get liquidated, but somebody just does a redemption. You're like, wait a minute, I wasn't liquidated. My collateral health is now 115 or 117 or whatever it ends up being, if it didn't just close it out completely, and it saved you from liquidation. So like the price of USDL went very quickly back up to $1 on the DEX, and the redemption helped the entire ecosystem shove itself up into safer collateral levels.
So here, and I've asked you this before, Jesse, and you didn't want to answer it then. But here we are talking about, liquidations and different ways that that people can be redeemed, right? So here's a question that I have: Are you, and it's a little bit off topic, but I have to ask: Are you familiar, or Jexxa, are you familiar with any kind of like flash loans protocol that's being built on or going to be launched on PulseChain?
Okay, this is important. So understanding how a flash loan works is it tries to manipulate a system. So first of all, I'm not aware if there's any being built, but sure there are. They can be thwarted quite simply by using time-weighted averages. So the way a flash bot works, or a flash loan works, is it can only take place within a block. We've got pretty fast blocks on PulseChain, 4-second blocks, let's say.
I'm familiar with that, but there are flash loans that work on very, on fast protocols.
Yep, probably are. But if they've got a time-weighted average that they need to sustain they need to push the price down on whatever asset they're trying to manipulate and sustain it there for a period of time. Now, things that don't rely on time-weighted averages for their pricing and things like that are susceptible. But if your system is waiting that time over more than one block, it's very hard for Flashbots to maintain that sort of, because they have to pay back their debt at the end of that block. Okay, so unless they can achieve what they want to do in that short space of time, then it's not a risk to the protocol that's using time-weighted average.
Okay, I think I've got it. Hey, we've got some more people who've requested to speak. Right now, I've brought up what's not on the news. You can speak now. I'm actually going to remove the couple of people who we've already had speaking. TCP, it looks like you want to say something again. No? Okay, you removed yourself. Okay, what's not on the news?
Hey, thanks for having me on. I just came up to say hello, and I wasn't quite sure what the space was about, but I did have some questions that I could ask Liquid Loans. I just had them written down, and I'm trying to find them at the moment. But I also was just going to say, I know you guys are talking about building on PulseChain, and my normal account's host Sean, or Sean K. And I usually, okay, I found my question. So, my first question is like, why is there a sacrifice? And I just wanted to know more about that, and then I can continue on with a few more.
So we actually already covered that a little bit. PulseChain benefited from having a sacrifice, and people really liked it. So I think,
got it.
You've got to understand if you were no expectations and sacrifices, putting your money into a bucket with no expectations, I understand all that. But understand what can be done off the back of a sacrifice in terms of supporting protocols. You only have to look at Hex to see that. So obviously we can't go down too many of these rabbit holes for legal reasons.
Okay.
So you need to galaxy brain that.
Well,
yourself
and
a
I
little
mean,
bit.
there's a lot of reasons, but the simplest way of explaining it is kind of the way that you guys said when I mentioned is like it's some of it has to do with understanding the Hex Pulse community a little bit, and like that this has been a successful model in the past.
Yeah, but there's a reason why you have that model and what comes out, what's the benefit out the back of that.
Yeah.
So let's just take an argument. Liquidity, who launched on the Ethereum network, they took VC money to be able to develop and produce their code, and so now they're beholden to some VCs in the background. That means that the community doesn't get to own any of that protocol because the VC took a fair chunk of it. So that's something to consider.
Got it. Okay.
And we essentially, Liquid Loans gets the benefit of all their hard work. So those funds that they spent on audits, modeling, all the development stuff, we pick up at a severe discount. So what does that free a team up to do in terms of promotion and support and underpinning things? But if you don't take up that VC money, you don't have those costs that they had, there's a lot of benefit.
I mean, I can speak just not specifically about your protocol, but about, as someone who works in crypto, in the crypto marketing and incubation space, we work with a lot of projects. I work with a lot of different projects, and some of them are, did take heavy VC money, and they have to run everything by them, and they say no to things that are really, they should not be saying no to because their VCs think that they should. And it is sometimes very, very challenging to work with those projects.
We want liquidity to be owned and used by the community. So if the community is getting all the fees from that protocol and it's the tool that they're using, that's a pretty nice model to have.
Okay. Yeah, and I do see like a lot of projects starting these sacrifice things, and I personally hope that it doesn't become like an ICO like it was back in 2017.
Yeah,
but
I agree.
We never know. It's a good system that they created. Also, I had a question about like similar to what happened to Titan on Iron Finance. Is there any steps that you guys are taking to prevent the loss of peg?
Yeah, so the protocol itself is, and I use this term a lot, so it's a beautiful protocol. Just in the way the mechanics of it work to maintain peg is just beautiful. Like it's, you've got to read through the white paper a couple of times to get your head around it, and it's taken me a few reads to understand it. And then obviously I've done all those videos I mentioned, so you can check out them. But things happen instantly in terms of getting the system back into balance. There's no auctions that you need to happen to bring pegs back into line. Everything is just almost instantaneous. Jesse's spoken to this point already, and he was talking about what happens on a DEX with price. So you could imagine, let's just say that something diabolical happened and the price of the stablecoin, USDL, went down to 90 cents. Now, if you can take that one USDL, which is you brought on market for 90 cents, and go redeem it for $1 worth of Pulse, how many people do you think are going to arbitrage that, and how quickly do you think that opportunity is going to disappear? If you could print free money, 10% over and over again, just by redeeming, what do you think happens to the price of that asset? So that the peg will shoot straight back up. And it does that because of two reasons. Obviously, you can redeem You can redeem Pulse for $1. So people are going to be looking to buy up that token, that stable coin, because they can see there's an arbitrage opportunity. So just simple buy pressure will push the price up. But there's more than that. There's the quantity of money theory. So every time someone redeems that USDL, it takes it off the market. So, and this happens in normal financial, in the real world, in legacy with fiat currencies. Quantity of money, it determines inflation rates and values of money. So if you're removing money supply, the tokens off the market, that has an impact on price. So these things happen at light speed in this protocol.
Copy that. So yeah, I just have a couple more questions I'd like answered. Is there a percentage of tokens like the founders will receive, or is that going to be disclosed, or is it going to be similar to like how, you know, the PulseChain sacrifice?
You're going into a sacrifice, so no expectations. Okay, so we can't and won't talk about that. If you want to see something, if you want to see how Liquidity done their token model, you could probably check out that, and that looked like a pretty good model. In terms of the VC money they took, in terms of the sacrifice, so points are awarded the same way as PulseChain and PulseXpert with the volume multipliers. The only component extra we have, that the sacrifice has, is a mechanism where you can choose to have your points locked for up to 24 months. What that means is you can get a bonus of up to 2.5x on your points for locking longer. So what it does is it creates a scenario where if someone comes in with a lot of money for the sacrifice, they can get the rewards on the volume side. But if someone has a smaller amount but still wants to benefit, they can go longer, much like you can in here. So that delayed gratification mechanism can level you up. That's the only other mechanic that's additional.
Okay, so yeah, that does make sense. And also was wondering if there's going to be a Liquid Loans testnet launch and why it's running on private testnet, if it's just like a simple fork.
Yeah, I like everyone says a simple fork. Understand PulseChain is so embryonic that it doesn't have a lot of the tools that the ETH network has. So sometimes you've got to wait for the substrate to catch up. And so that we've got things that we need to wait for before we can do our component. Now,
further, you guys are actually not planning to launch with PulseChain's launch unless that's changed since the last time we talked. Do I understand that correctly? You guys, you're not intending to, you know, go live with this lending?
No, I mean, yeah, I think given the nature of the protocol, it would make sense for whoever launches that protocol to delay it a little bit, just to let the initial volatility of Pulse settle down. It's going to be crazy. You've got guys that have sacrificed for Pulse X, guys that have sacrificed for Pulse. Some people are getting a doubling of their hex, and there's going to be this period of settlement. So we know there's potentially going to be a time where everything has zero value and you're working on pure ratios. People will do some crazy things during that time because they won't understand what the ratio means. If they're swapping and trading and all this craziness that goes on, and then a price gets injected into the network. And then you've got to go through that period of adjustment and letting things bed down. So launching, it doesn't pay to be first out of the gate with something like that. Give the network a chance just to settle, let everyone get over their FOMO side of things and get it out of their system, then launch into a more stable system.
Okay, thanks. And I just have one more question. And I don't know if this has already been answered, but exclusively, like when you guys do launch, will there be any audits considering the ETH and Pulse code isn't identical, it is different?
So the ETH and Pulse code is irrelevant. That's the consensus layer. What is important is if you fork Liquidity and you make any changes, those changes need to be audited. Now, much like Pulse, so this goes to the point of this chat, hypocrisy and things like that. What's happening to PulseX, the fork of Uniswap, fork of PancakeSwap? They're getting audited? Nope. Why not? Because there's only a small amount of changes that need to happen. There's Liquidity that's been around, it's sitting on the chain, it's being used actively, it's just getting forked. So the audit, whilst we do it, it's very minor items.
Okay, so that said, there unless things have changed, Jesse, I know at one point you guys said yes, there will be an audit. That's, you still are planning to not launch until there is an audit.
We will not publish this code to the blockchain without it. It would be
crazy.
Would not be in anybody's interest to make a mutable code. And even if that's only one single line of code, right? If you make any changes at all, you need to have an audit company run that through the ringer and try and break it, and then release their report saying, yes, this is good, or yes, this is, or no, this isn't good. So it would be stupid not to do that.
Yes. Agreed. Okay. I wanted to make sure that, first of all, that things hadn't changed since the last time that we spoke about it, and that it was very clear to what's not on the news. Yeah.
So sorry. I hope I wasn't misinterpreted then. I was trying to draw some parallels as to other things that are happening. But yes, we are getting an audit.
Okay. More questions? What's on the news?
Just one more. I was wondering if it's like a completely decentralized protocol, or if it is going to have like a corporate structure when it comes to liquid loans.
The protocol is completely decentralized. Once it's launched, it's in the hands of the community. Now, an entity closely related or some of the team may run a front end, so you can engage with that protocol, but that doesn't preclude anyone else from running front ends to engage with the protocol. So it's decentralized at the core protocol level. And sorry, I'm not sure if I've just cut out. So it's decentralized at the protocol level, and it's decentralized at the community front end level, where anyone can run a front end. If you like the way Hex works and you can interact with Hex using multiple front ends because it's decentralized, you're going to like the way this protocol works.
Thank you. Thank you for clearing these questions up.
You're welcome.
Thanks for your questions. All right, I'm going to bring up, there's 2 more people with questions, and then let's kind of wrap things up if that works for you guys.
Sure.
Okay, so we've got Mad Hatter. Mad Hatter, you can now speak.
Hey, good evening, everyone. Hey, NrdGrl, first, I just wanted to say thank you for putting this together, and the Liquid Loans team. Really appreciate you stepping up in the Twitter spaces for an open AMA. I think that speaks volumes just to be here to answer the questions that we have. I guess my first question, I think Sean touched on quite a few of them. So with something like recovery mode, how fast are users going to be able to add collateral when that kicks in, right? So when the system falls to 150% collateralization ratio, able to add collateral before they start going through and getting liquidated.
Yeah, so the system, so first and foremost, recovery mode is not a desirable state to be in. So as a whole, the system steers people away from ever having to be in that position. I don't think I've seen liquidity enter recovery mode ever. Okay, and we went through a very sharp drop in ETH the other day. So how does that work? So much, and I used an analogy on a stream last night where in Hex we have an average stake length of 6 years. Now, does that mean everyone's at 6 years? No. It means there's a raft of people up at the 15-year mark. There's a bunch of people down at the 1 year mark, the 30-day mark, and anywhere in between. And so what we end up with is a good distribution of stakes along that curve. Much the same thing happens in vaults. So some people will collateralize their vaults at 5,000%, 10,000%. We see this on other chains. Then you'll have people that do it at risky levels, whether they're trying to use the system for a different purpose, or they just neglect their vault. They don't ever maintain it. What you end up with is an average of collateral ratios across the whole system. We call that the total collateral ratio, which is that 150% term that you're referring to. So when the system gets down to that 150%, it goes, look, we need to do something. If we don't act now and price falls, then people are in danger we're in danger of becoming insolvent. So we can't redeem a USDL for the pulse. So it does everything it can to protect that. Now, so on liquidity, the TCR is usually running around about the 200 to 250%, which is really stable. Like that's good. Now, what we would like to see on liquid loans is it run at a lot higher level. And that's why we're out here educating people on what we perceive to be good level. We think the minimum should be 200 to 250, but that's not what we recommend. That should be your minimum. We recommend maybe up at 1,000. So the system is, as a whole, is really well protected. So to answer your question directly, how often do you see a 70% dip in crypto in one candle, in one daily candle? It's very, very rare. You see that play out over the space of a week, 2 weeks, a month. So you can see the price coming down. Now, it might drop down 30% and back up 20%, but you'll see it come down over time. You've got all that time to make an adjustment on your vault. So it's not like you need to be watching this thing like a hawk and jump on it as soon as there's a price move. It's not the way it works. If you've collateralized safely, you have ample time to react. How do you fix that? You can pay back some debt. You can add more collateral. The system, if it does go into recovery mode, does certain things where it'll change the fee rate. It will limit minting of USDL. So different things like that. So it'll put actions in place that force and incentivize the behavior of the participants to bring it back into a healthy state.
Thank you, Jexxa. I appreciate that answer. And I also just wanted to say, when I was first introduced to liquid loans and I started, doing my own research, the message that I was hearing wasn't necessarily what the dangers were. And right, you wouldn't necessarily want to market that when you're starting any kind of new project. But I do want to say that I appreciate at least that there's some more education going on. And I think that's the key here, right? In terms of, we don't necessarily want to try to pad the world and protect everybody, right? There are these protocols that exist. There are people that are going to use them, both people that understand what they're doing and people that do not. And so I think spaces like this, where we can have an open dialogue about some of the benefits as well as some of the risks, are crucial as we start moving into this DeFi world, and especially launching on PulseChain. I think over time, PulseChain is going to introduce many new players to the ecosystem that may never have been involved in cryptocurrency before. They may never have traded, and they may never have used leverage in any form or fashion. They may not understand liquidations or what that could entail, or safe collateralization ratios. And so I think what you're doing right now is the best the absolute best thing in terms of educating in a space like this to both people that understand leverage as well as people that don't. So I did want to say thank you just for coming on and for answering these questions. I think as a community, at least the Hex PulseX community that's kind of rallied around Richard Hart does carry a certain ethos in terms of some of the things that you've all addressed in terms of audits, in terms of no expectations, but at the same time, having a track record of success is helpful. And so I would continue, I would absolutely encourage you to keep jumping in these spaces and educating. I'm doing the best that I can as well to educate, as well as warn people that if they're not familiar with using leverage, to get familiar before they start taking those risks. So thank you, Jexxa and Jesse, as well as NrdGrl.
Thanks for the kind words, mate. I couldn't have said it better. We're a community that we're part of the Hex community, we're part of the Pulse community, and we just want to see everyone move forward, do things in a safe way. Now, the tool we're bringing to market is what the wealthy use. Now, if you know how to use that tool, it's great. So that's what originally, when I joined the team, I said that's what I really wanted. The message I wanted to punch through on was educating people on how to use these tools. And I think this, like you said, this is the best way we can do this, is just get out in front of people, let them know how it works. I probably do want to touch on some of the margin side of things, because I think this is really important, and this is the headlines that we see in crypto all the time about. We see a headline of $100 million was liquidated today when a Bitcoin had a big wick. And you're right, that is people not understanding how to use leverage, but also using it in a really, really risky way. And when you look at how leverage is used on exchanges, they're borrowing money they don't have. So they deposit $100, say, and then they leverage that up 10x, 100x, and then they go and place their trade. So that leverage position they've taken is money they don't have. So when you get a small move in the market price, they instantly get liquidated, because they don't understand that a very small percentage move will wipe out your $100 instantly almost. And then that causes cascade events on those exchanges, because you get liquidated, drops the price, and then you flow on effect. In liquid loans, it's the opposite. You are borrowing against a pool of assets, so money that you already have, you're taking a small fraction of it out to do something useful with. So this is not uncommon for the wealthy to use these tools, and it's not uncommon for the average person in real life to use these tools against something like their own home. They buy a home, they live in it for 5 years. It goes up in value, there's equity in there, they go get a line of credit or draw down a little bit of funds to do something they wish, renovate, go on a holiday, whatever it is, buy a car. That's a pretty, that's a safer way to look at this, is you're borrowing against something you already have and just taking a smaller position. So when people hear about liquidations and leverage, you've got to understand that this comes in all shapes and sizes.
Agreed, and very well put. And thank you again for doing the education. Right, because I think the last thing we want to see is anybody that's entering this ecosystem get hurt. Right, I think we've seen examples of that over and over again, where people don't necessarily know what the tools are that they're utilizing, and they are utilizing them in an unsafe way. And so if we can educate, sorry, go ahead.
So we see this every day with credit cards. People get into debt spirals.
Yep, absolutely. So thanks again, NrdGrl. I'll step down. I think the rest of my questions have been answered. And thank you for the opportunity to ask them.
NrdGrl, I can see there's another speaker you've lined up.
Yes, so just a couple quick questions. First, I'd like to say thank you so much, guys, for coming on here. This has been amazing. Kind of came halfway through, and you guys have been explaining this protocol very well. I would have to say this is probably one of the safer leverage protocols I've seen. I've used it, in other cryptos before. Couple quick questions though. First, I'm sacrificing for this protocol, but I don't really understand the staking that you guys have, where I can stake out for 2 years, and I guess I get 2.5 coins. What will be the purpose behind that? Why wouldn't you want that in circulation up front? The second part of that question: wouldn't I make more APY by just staking the loan tokens when I receive them up front versus staking it out? The 2 years.
Yep. So actually, earlier today, I made a video. If you look, I'll explain it to you. But after this, if you want a more in-depth explanation, check out the Liquid Loans video that we made today on the official Liquid Loans YouTube.
Okay.
But basically, you have the option to delay your gratification for up to 2 years, and if you were to do that, you would get 2.5x multiplier bonus on any potential points that you would receive. Okay, now compare that against no multiplier bonus, and you get your points, and they all are released to you right on day one of the protocol. Now, you could assume, probably correctly, that your perceived dollar value, you could probably, this is crypto, within 2 years, you could easily 2.5x your dollar value. This is crypto. You see things go through doublings and triples, and like over a period of 2 years, like that's not unheard of. But what the trade-off here is, you're delaying your gratification for a guaranteed multiplier on your coin, and basically a coin count, right? So check this out. Let's say that Pulse goes up in value. We all hope that it will. Well, you can guess that as Pulse goes up in value, people's collateral levels are getting healthier and healthier. The loans are going to get bigger, and the fees are also going to get bigger, which in turn, it all trickles back to the value of that loan token. So if Pulse goes up in value, you'll see that the loan token is going to kind of follow along, and the loan token will become more desirable because holding it and staking it will earn you more fees, higher fees. If it goes up in value and it runs away from you, do you think you'll be able to 2.5x your coin count? What if Pulse does 100x? What if the loan token does 100x, right? And you can't get your hands on the coin count that you'd like to have. Now, there are other ways to earn these coins by being a stability provider, but that being in the stability pool, those rewards go through halvings. It gets harder and harder to get your hands on these things over time. And as more and more people enter the protocol, there's some dilution effect there, where the rewards that you were receiving, more people are participating in the stability pool, more USDLs in there, you're getting less and less and less of these tokens by being a stability depositor. So to assume that you'd ever be able to 2.5x your coin quantity, like you might not be able to do that. So imagine this also. So you stake, you get an APY, it's very healthy. And then every month there's people coming out on top of you who put in the same economic energy as you, and they have more coins than you. And at the 2-year mark, somebody who put in the same economic energy as you, they have 2.5x the coins that you do. What are you going to do with the earnings that you were making on day one and all the way through those 2 years? Are you going to spend every penny of it on trying to acquire new coins? Are you going to be putting some of it into Hex? Are you going to be withdrawing some of your USDL that you're earning from the fees and buying groceries with it? Right? So I'm literally telling you that you can't automatically assume that just because you come out on day one and you're getting a good APY, that you could ever dream of getting a 2.5x on a coin count.
Okay. That makes sense. I just want to have the right strategy when this happens. So, yeah. All right. That answers my question.
And there's more to it than that as well. So what do we like about HEX? People delay gratification. What does it do? It dampens down or sell pressure. Same, and this is what we're seeing with PulseX now. What can you do with it? You can stake it. Why do you want to do that? You want to take some of it off the market and I guess temper the release, the emissions of it, because that's price positive.
Exactly.
So there's a lot of things that have gone into this.
You know what's funny is I've talked about this a lot recently, is that, you know, while originally the whole idea of time locks was what, you know, so many people in crypto were so appalled by about Hex. And what's really, really, really funny to watch like in real time and to some degree behind the scenes is the extent to which time locks are now being adopted.
Yep. Very, that goes back to your hypocrisy, doesn't it?
Yeah.
I think, and I don't know whether Hexicans realise this, they're probably 8 to 12 months ahead of the rest of crypto in terms of the tools they use, what they understand, whether they realise it or not. And Abram talked about this on Rag Richard yesterday. They're very well educated. They're using DeFi. Most people in this space come at it from a pure speculation play where they go buy Ethereum on a centralized exchange and they hope that the price goes up. So they don't give two hoots about how expensive the fees are on Ethereum or what works, what doesn't. They're just looking at the price going up. There's a much smaller subsection of people in crypto that actually use the tool. Now, Hexicans have, through a lot of the gatekeeping that's happened as well, they've been forced to use DeFi for its intended purpose. And don't underestimate what you know and what you've learned from doing that.
Oh, you wouldn't even believe, you know, when I started the job that I have right now, I honestly didn't think that I knew that much about DeFi, and it turns out that I really do.
I want to add another point to all this. And, you know, the narrative of never selling your Pulse coin because you'd like to capture all the appreciating value of it, that actually trickles all the way to the loan token itself. As a loan token that you have staked is appreciating in price, it actually could be tempting to sell it, right? So we don't know what the price is going to do, right? Nobody has a crystal ball. But let's just say that your token 100x'd in price, and it's very tempting to sell that. But you have to keep in mind that if the price of that token 100x'd, you are getting 100 times more of the fees for somebody who brought the same economic energy as you. Right? So if the token was 10 cents or something, right, and it 100x'd and it's now $10, somebody else who put 10 cents in after 100x they're getting 100 times less of the fees than you were for the same economic energy. So keep that in mind.
Sounds like T-shares, doesn't it?
Excellent point. Wow.
And, you know, here's another really, I think, important aspect that we haven't gotten into very much, and we probably don't have too much time to get into it now, but just I think it's really important to mention, you know, a reason that a lot of people may be reluctant to sell their coins isn't because they don't want to realize some kind of profit. It's because they don't want to pay taxes. And we've got all kinds of people, you know, moving all over the world to minimize their tax liabilities. Well, taking a loan is not a taxable event. Is that right?
Correct. Yep. And I don't understand why we initially got so much pushback on this. When you understand the mechanics and how that works, you're spot on. If you can extract value in a tax efficient way, and we talked about what happens when you pay back loans and things like that. There could exist a scenario where you never ever have to pay that loan back. And that's why the importance of having no interest rates into this system is really important. What do I mean by that? You lock up some Pulse and things go extremely well for the chain and it goes up 10x, 100x, 1000x, whatever. The value of your Pulse has increased exponentially. And if you take out a small amount of extract a small amount of that value in the form of USDL, it could be insignificant relative to the amount of Pulse you have in that vault. So you may never choose to pay that back. Like Pulse may just keep going up over time, and that gets even more and more insignificant the amount you've taken out. So there could be that scenario where you just never, ever need to pay that back. Or if you've got HEX stakes, you could relieve a bit of interest and pay back the debt on your loan if that's a big issue. But there could be that scenario where you never, ever have to sell a dime or never, ever have to pay it back.
But you know what's just like so crazy about all of this to me is that I'm thinking, okay, so you own this, so you have this loan, right? But it's not like the kind of loan that we're seeing reported on people's credit scores. This is a, you know, completely different thing. And then this makes me realize like credit scores not going to be a thing anymore. Like we are witnessing the end of what we think of as finance.
I hope that's the case, because I think credit scores are a shocking thing to have. I know they're really big in the US. We're lucky in Australia we don't have them to that degree, but I can see that inching in now where there's a lot more reporting taking place on your credit file. I hope we don't get to the point where the US is, because that sounds very discriminatory to me.
It's horrifying and like, you know, really, really difficult to get yourself out of those situations where you have a poor credit score, because yeah, it is horrible. I would love to see the death of the credit score.
Here's to
All
that.
right. We've added someone else as a speaker. We've got Haunted.
Oh, I was just going to add to Jesse's about the loan token when when the price goes up and the economic pressure to buy. I was just going to add, if you get it in early on a project, and it's a project like Liquid Loans, it's a farming project or it's a staking project, and you're making a yield from it, so that you get in at $1 and the price goes up 10x and the APR is 20%. You got in at $1 and the price is now $10, but the APR is 20%. Your actual initial investment is really 200% from what you put in, because you've done the X's. You've held early. You were there from the beginning, and the price is done at 10x. You're actually making a lot more than what someone would do if they come in with $1,000 then. So you'll be making if say you bought $100, and one guy bought $100 after a 10x, and the APR was 20%, you'll be making $20. Sorry, you'll be making $200 while the other guy will be making $20 a year. So you got to keep that in mind as well. Being early can be very beneficial as well.
I guess the simple analogy that everyone will understand is this. When HEX started, the T-share was 60 cents. Now, T-share is what? I don't know, $4,000 or something like that. They still pay out the same interest. Someone's just paid 60 cents for that T-share, but someone's just paid $4,000 for it. Exact same thing.
Yeah, bingo. That's all I wanted to add.
Cool. Thanks, mate.
All right, awesome. Okay, guys. So since there's no more requests, I guess let's go to what have we not discussed that I guess, you know, how people can sacrifice. You guys have already said you're not going to give out the specific date. What can people do right now to get ready so that they're able to sacrifice right away?
So the sacrifice is only accepting stablecoins. As Jesse said, it's a sacrifice for your belief that centralized stablecoins are not the way the industry should head, and you're sacrificing because you are hoping that a new and better decentralized form of stablecoin will come into existence. So therefore, the sacrifice is only accepting stablecoins. So if you plan on participating in the sacrifice, you need to have your stablecoins ready.
Okay, stablecoins ready. What wallets or exchange, or I guess everybody needs to have their coins probably in a self-custodial wallet, right?
Correct. Yeah, same as what we've been through on Pulse and PulseX. Have them in a wallet you control the keys to. Very simple process. There's no DApp or anything like that. There is going to be a verified address that you send funds to. The only slight nuance is if you wish to be part of the longer pays better and get more sacrifice points, it goes from 0 months out to 24 months. So the way you would do that is if you wanted to have your gratification delayed for 12 months, you might send $100, but you'd send it as 100.12. So that's how you'd put in your stablecoin balance, 100.12. That would lock it for 12 months. you wanted to do it for 8 months, 100.08. Just so that everything's on chain. We can see who's electing to delay gratification. What that also means is you can build a ladder. So you might go, well, I don't want to go out 2 years. I wouldn't mind some at the beginning. So you can do that. You could say, okay, I want this $100 to come out instantly, this $100 to come out in 12 months, this next $100 to come out in 2 years. So you can tune that to whatever suits your needs.
Sure, that makes sense. That reminds me of how I was strategizing before Hex, when the Hex was still in the adoption amplifier.
Yep.
All right. All right, Jesse, anything else that you'd like to share?
You'll typically find admins or myself or Abra in the Telegram from almost all day long, 24 hours a day. People are answering questions. t.me/liquid loans. And then our website, liquidloans.io. Sacrifice is right around the corner. Make sure you look out for myself or one of the other core members on some streams announcing it. Double, triple, quadruple check across all our social media platforms and our Telegram page to make sure that you're getting the accurate information. And thank you for your time. Thanks, NerdGrl. Thanks everyone for your questions.
So there was one more person who requested, and since I know you guys really wanted to answer all of the questions that we, could, I decided to bring him in. It's Tank Man. And then after this, I promise we'll say goodbye. Tank Man, you are now allowed to speak.
Can you hear me?
Can. Yep.
Yeah.
Hi.
Actually, the question was answered. I hit the button a little prematurely. My question was that during the sacrifice, if we could split our sacrifice up to be set at different links from that, 1 year to 2 to get that bonus, and it was answered. So I appreciate that. Thank you.
Okay. Awesome. Hey, can I ask you a question?
Yes.
So your Twitter bio says you're an entrepreneur, a crypto connoisseur, an NFT newbie, and an angel investor. So you're listening to this podcast or, to this Spaces. I take it you have some interest in liquid loans.
Yeah, actually quite a bit of interest in liquid loans. I'm on OG Hexagon. I've been in since, OG meaning I got into the project about 6 months after launch. First day sacrifice for Pulse, first day sacrifice for PulseX. I own a couple businesses. I'm an angel investor and have invested in about 15 businesses. So I'm active with the money that I have, and liquid loans is something that I'm really excited about. I mean, I'm excited about Richard Hart's projects to begin with. Have been, following him for quite some time, and I think the liquid loans protocol is going to add a whole different layer for us to be able to extract some funds and be able to do things with it. And that's what I'm excited about, because I'm not just in crypto. I'm developing an NFT project right now. I'm doing a lot of other things, and I'm really excited about this. And I've been listening to this protocol and this project since it was first announced on all the different platforms I could find, on all the different YouTube channels I could find, following these guys, and I'm really excited about it.
All right, awesome. So for those in the audience who may be, skeptical, skepticism is great and everyone should do their own research. But here's one angel investor who's saying that he is very interested in liquid loans. Thank you very much. All right, guys. Thanks so much, everyone, for being here. Looks like nobody else has asked to speak. So let's wrap this up. You guys can find Jesse and Jexxa both here on Twitter. And what's the name? Can you give your Telegram group one more time?
t.me/liquid loans.
All right. That's pretty straightforward. Thanks, guys, for being here. Thanks, everyone, for tuning in. I hope you have an awesome night.
Thanks for having us, guys.
Thanks, y'all.
Bye, guys.